Okay, here's the YM again for August 10th, 2007, 2-minute chart. Our trader is looking to take a trade here. You notice that there were breakouts to the upside. This one here failed. Trader broke even on that one. This one trader took and was a success. And you made one standard deviation on that trade. And then you notice that the market retraced right back down again. You could use the Shapiro effect here, by the way, once the retrace occurs, and look for confirmation for a trade back up. In this case, you would look for a trade beyond 13,232. That didn't occur, and the market's moving right back down again, right back down to the VWAP down here. So when this occurs, if we break through the VWAP, we will wait for, again, a retrace to the VWAP and then apply the Shapiro effect and see whether or not a trade to the downside would be a good trade. In the meantime, all you can do is watch. Not much else you can do. Again, possibility for scalpers to take trades back and forth across the PVP here. If you like scalping, this would be the region to be doing it in. I usually don't take trades here, but it's doable. Market's oscillating again around 13,203 at the PVP. Does that a lot in this region. A lot of oscillations take place. So that's why you have to be careful as a trader to let the market decide for itself which way it wants to take itself. We did have the breakout initially here to the second standard deviation, but it backed off again. And then there was a retrace, but there was no confirmation that the market was going to continue to the upside. And so we're back into this DMZ region where we just sit and wait to see what will transpire. We'll take trades in either direction. We don't have any specific bias, either long or short. Market breaks to the upside, take an upside trade. Market breaks to the downside, wait for a retrace, take the downside, short trade. You're happy with either one. So we're at the PVP, 13,203. And it's 11:26 a.m. on the East Coast. Okay, market's moving back up again. Will we break through here? No, backing off. We just sit and wait. You notice how skewed this distribution is, by the way, to the downside. And so your expectation would be that if the market breaks through here, through the volume weighted average price, it should just continue right on down. Negative skew. Negative skew, VWAP is less than the peak volume price. Positive skew, VWAP greater than the peak volume price. No skew, VWAP about equal to the PVP. We haven't discussed trades when that happens, but we'll do that in a later thread. For now, we have a negative skew and our expectation would be to move back down to the volume weighted average price. And below. Okay, market seems to be moving down. Heading down back into this, in the safety of the negative skew. This is where most of the trading has gone on, from the peak volume price on down to the low. And we'll look here for a trade on the short side if we break through here and we get a retrace. Of course, it could break through here and just continue on right down without a retrace. So you might be out of luck if that happens. Depending on how aggressive you are as a trader, some traders might take the breakout below the VWAP. Well, if you did that over here on this bar, it would have been a failure. So you would have lost money on that trade. That's why I always say wait for a retrace. Use the Shapiro effect if you can to decide whether the trade is going to be a good trade or not. Remember, the Shapiro effect says if a trade looks good now, it'll be good on the next bar or the bar after that. And I interpret that to mean that if the breakout occurs at the VWAP and there's a retrace, an up bar, wait for that up bar to be violated before you take the trade. Okay, we've broken through the VWAP here at 13,184. We are not in the trade, or we don't take a trade unless we're very aggressive. If we were very aggressive, we'd be in at 13,183 and not wait for a retrace. And so the market seems to be heading down. The first reaction, of course, is, oh, we missed the trade. Bummer. Well, if you missed it, so you missed it. Wait for the next one. Okay, market does seem to be heading down, but that also happened here on this bar. And you lost on this bar, or at least most you broke even if you took the trade to the downside. So that could happen here too. 13,183. Let's see if this thing retraces back up to the VWAP. So again, we're in the negative skew region. This is where you always like to look for good trades and wait for retraces to take those trades. So we're waiting here and seeing whether or not the market will retrace to something like 13,184. Now normally I would tell you take an entry at 13,183. But that was back in parts 1 and 2 in the early days of your trading. I didn't want to complicate things too much by telling you about the Shapiro effect, but I posted on the last thread some information about that, which you should read. That was in part 6 thread. And so you would wait here for the market to retrace to around 13,183 and on an up bar, and then wait for that up bar to be violated. That is, wait for the low of that bar to be broken and then enter the trade. That's always the safest place to take an entry. You see, if you didn't do that here, where the market moved back up to the VWAP, if you entered immediately, you would have been in a losing trade. Market just kept rising. So you don't enter right at the retrace at 13,183, but you're going to wait. So we have an up bar here, back up to 13,183. And by the way, our aggressive trader, if he'd taken a trade here at 13,183 on this down bar, would have been stopped out at break even. Okay, so we have an up bar, another up bar, and now we're going to wait for a down bar. And the down bar has to break 13,178. So if we get back to 13,178 and below, or 13,177, we'll pull the trigger. Pull the trigger to the downside. If the next bar after this one completes heads back down below the low of this last up bar around the VWAP. So we're looking for an entry. 13,178 is our entry point. Let's see where this bar closes. Its low is 13,179, so we look for an entry at 13,178. So we're waiting for that bar to close. Just watch. Okay. Now let's see if we get a down bar. And if the down bar goes below 13,179, touches 178, we'll enter the trade. Okay, 13,179, 178, touched. Yep, we got a fill. Okay, that's the Shapiro effect in action. We're in at 13,178, and our profit target is going to be 13,154 for a 24 tick profit on the YM. Now I'm a very conservative trader, and when I see the market coming down like this, I don't want to lose any money on the trade. So many times I will move my stop to break even, which isn't always the wisest thing to do. But I would have probably been stopped out of this trade myself. I always like the adage, never let a profit turn into a loss. But many times when I do that, I end up with a lot of break-even trades. But you have to find your own trading style and see exactly what suits you. You should be in a short trade here. You're looking for the market to head down to that first standard deviation below the volume weighted average price. So perhaps if you're the type of trader that trades like my style, which is stops to break even quickly, perhaps you should wait a bar. Again, use the Shapiro effect on your own trade. Wait till the bar completes and then move the stop to break even. Okay, market's coming down, 13,164, 163. We're looking for 13,154 on this trade. 160, 59. 157, 55, 54. There we go. We got a fill. Okay, if you were trading just one contract, that's where you take the exit. If you're trading more than one contract, you should exit your partial trade at this point. Move your stop definitely to break even. And then wait and see if the market moves to the second standard deviation, where you take some more off the table. If you trade only two contracts, this is where you take the second contract. If you had three contracts, take the second one off and hold one as a runner. Move your stop to this point, 13,152, and hope the market will move to the third standard deviation. That's the nice feature of trading more than one contract at a time, especially trading three contracts. You can end up with a nice runner that just keeps on going. Keeps on going like the Energizer rabbit. Okay. Good trading.